John.
Exactly, yeah. We've known one another now for, what, 20 odd years?
Would be at least that, yes, if not a bit longer.
Yep.
Yes.
And you've been a sole practitioner for the last 18 years?
Correct.
Yep. And prior to that you were general manager of...
Managing Director of Edward Rushton New Zealand Limited, yeah.
Yeah. So your whole career has been in the valuation of buildings, both commercial and private.
Correct.
Right. So in the last 3-4 years, what changes have you actually seen in your sector of the industry in regards to valuations of buildings?
Well, the biggest change was probably after the Christchurch earthquakes, when the insurance companies changed their earlier policy from a total replacement policy to a more of a sums insured, or a declared sums sort of policy, which immediately meant that owners had to get their assets valued in some detail to ensure that they weren't underinsured. And so that brought on a whole new sort of wave of insurance work in the residential area, as opposed to the more traditional sort of commercial industrial work that we've been doing the whole time.
Yeah. Do you think that it was fair and reasonable for the insurance industry to make that move?
Oh, well, I couldn't comment on that, but I could certainly understand the reinsurers' nervousness after what happened in Christchurch, where they literally had an open-ended liability, and I think by having declared sums insured rather than a simple full replacement, they were simply trying, I think, to get a better feel for what their reinsurance obligations were. And I mean, you could kind of understand that, I suppose, if you got hit with the level of claims that arose out of Christchurch. So, and I believe that is, now that the insurance market is sort of recovering, I believe that is a little bit more relaxed now. I think the insurance companies are now reverting back to this full cover without sums insured.
Do you think that's a good idea?
Oh, well, I mean, I suppose it's a commercial move on their part, but, you know, if you have another Christchurch earthquake, it's simply going to go round in a full circle again, isn't it? So, I mean, you know, that moving away from valuations and sums insured to a sort of a full cover in the residential side of things, I mean, that was purely a commercial thing on the insurance company's part, wasn't it? I mean, you had one insurance company said, oh, we'll just do it on a full replacement basis.
Did I?
Whoever started it, and then the others followed suit because they were getting market share because of that as a marketing tool. The reinsurers obviously were happy to go along with it until the consequences of that were, you know, sheeted home with Christchurch. And I think as a result of Christchurch, you know, there was this move back to sums insured, but you know, again, the marketing side of things is coming out again, and you know, there are, I think, Tower
is one of them, and I think is it AMI as well has joined the ranks.
Is starting to just do a full full replacement cover rather than declared sums.
So one of the questions that many of my clients ask when they are doing valuation on their property for insurance purposes, and I would stress that I point out to them I am not a valuer, but I would suggest to them that they use a value of somewhere between $2,500 to say $3,500 a square metre on a particular property, basically to cover me in the event that I am totally wrong. I don't mind if they're actually, when they go to a valuer, they actually have a lower sum insured. But do you think that that figure of $2,500, $3,500 is a fair and reasonable approach to giving a, you know, off the desk equation for the value?
Yeah, well, I mean, it can vary so much. I mean, for a lot of housing stock in Auckland, for instance, the replacement value wouldn't be as high as $2,500.
Yeah.
So you could get into a situation of significantly over-insuring a property by just using a carte blanche. I mean, 2,500 to 3,500 would cover a lot of the new housing that's being built around the place. But of course, with the volume of building that's being built at the moment, of course, the replacement costs or the construction costs are probably less than that. But when you have to value it on a one-off basis, without the discounts that some of the big firms may get, you are looking at a pretty significant home that would be in that $2,500 to $3,500. You're more standalone, single level, brick and tile, 3 or 4 bed. You would probably be looking at a figure less than $2,500. Conversely, if you were looking at something in, a Ron Sang design, or an architectural masterpiece in Remuera or something, I mean, you might be as high, the Shore Road one, for example, as high as $7,500 a square metre.
Yeah.
So, just working on, I mean, as a rule of thumb, I think you're probably right saying to people, well, if it fits in that range, you may be about right, but it could be vastly overinsured, it could be vastly underinsured. But, it's always a little bit tricky just taking it off. You really need to know a bit more detail about the home, about the quality of finishes in the home, the quality of materials used in the home, and all of, I mean, these days some of the homes have got all manner of electronic wiring and wireless operation of air conditioning, of appliances and things, where people, driving home use their mobile phone to turn the heating on, so by the time they get home the house is warmed up. That's going to cost you a hell of a lot more to build than let's say the modal house, something like a more estate house, which is more low spec'd. They don't have garage door openers. They don't tend to have a lot of appliances.
Yeah, it's your basic home.
Exactly. So your basic home might be anything from 1,500 to 2,000 square metre, and you might find that 30% or so, 40% of your housing stock is in that range, and then you move up, and then when you get to that very top level, you might only be talking 5% of your houses. So you've got to be a little bit careful about applying just straight rates off without knowing the detail of what the house is. And of course, when people ring and ask me, those are the questions I ask them.
And you like to go along and see the premises as well?
Well, that's one part of it, and then the other thing you've got, of course, of all the special features. What have they got in the way of site development? As well as driveways and paths. Have they got swimming pools? Have they got, is it landscaped? Is it just lawns? Is it concrete block or decorative stone fencing? Some of these stone fences that are on the road frontages, I mean, they're hellishly expensive. And so, in replacement value terms, they become a significant item in the insurance. So, giving square metre rates on the house is one thing, but how extensive is the site development?
Because that also gets very confusing for a lot of customers, because they look at just the house, but then when I ask them about, okay, what have you got in regards to decks, what have you got in regards to driveways, retaining walls, etc.
One of the big items that came out of the sums insured environment that followed the Christchurch earthquake was retaining walls.
Yes.
I mean, goodness me, there have been insurance valuations that I've had to do on residential properties where we've had to get structural engineers in to actually do the replacement sum on the retaining walls, because if they're engineered retaining walls, there ain't no square metre rate that's going to help you out there. They've got to be specifically valued and costed on a replacement basis by an engineer who knows what he's doing.
And then of course we had that case just not so long ago where the client actually had to drill down to bedrock before the city council would actually give
Absolutely, and that's going to be the case where homes are built on reclaimed land, or land that's not natural, be it from historic slips or whatever, where you've got an accretion sort of situation arisen, and then they're now building on it. In the case of an earthquake, it all just turns to liquefaction and just literally runs away. So,
Yeah.
you know, if you have that sort of situation along some of the Auckland waterfronts, you're going to have a few houses on stilts in the future, you know.
Yeah. All gets a bit messy.
But, you know, these are the issues that, again, going back to your square metre rates,
Yeah.
you know, you ain't going to cover yourself
For
in
that.
glory
Yeah.
if one of your clients has a loss and he's got those sorts of special features. And I'm thinking of that Shore Road property, which, you know, is really quite unique. But it's unique at the moment, but it may not be with new houses being built in the future. Sort of highlights the risk of the insurance companies who take on this carte blanche, will do full replacement, because they could get caught out significantly, you know, if there are retaining walls or these foundation issues or whatever.
So what are you saying? Are you saying then that Mr. Joe Bloggs, who goes to AMI Insurance or to Tower and buys their policy on the basis that they're going to get replacement value regardless, and they go to that insurance company just giving the basic of details? Are you suspicious that maybe that insurance company, in the event of an earthquake, could possibly turn around and say, hey, well, wait a second, you didn't actually disclose or tell us?
I think that's inevitable. I think that is absolutely inevitable. I mean, if the replacement of a property that they've got a full cover on comes up for a claim, and they suddenly find out that, oh, there's a $100,000 retaining wall, or oh, there's a $150,000 special foundation design on this house, they'll simply say to the owner, hang on, you didn't declare that to us when you know, you said you had a 2,000 square metre house, and, you know, it was brick and tile, and that's what we've insured. You know, so, I mean, well, you know better than I do the sort of litigation that comes out of insurance claims. And yeah, exactly, and I believe that that is an area. I mean, if that homeowner was doing his insurance through a broker, he would never get away with it, because the broker would typically drill down and get that detail out. The problem arises when they get on the phone straight to State or straight to AMI or something and do it over the phone. That's fraught with danger, I believe.
It's like dealing with the IRD, really.
Oh, I don't know. I don't think anything's as bad as dealing with the IRD, particularly if you're on the wrong side of them.
So, cross-lease properties, where there's a house joined at the hip with another, how do we work out the replacement values of those when part of that house is actually connected to the other home?
Yeah, I mean, I've long held the view that cross-lease properties need to be valued for insurance purposes the same as body corporates.
Interesting.
In other words, you do one valuation for the whole structure, and then you divide it up between the cross leases on the same basis that you do for a strata title body corporate type setup, because otherwise you potentially could get an inside unit that's fully insured, and the sums for the replacement of that unit may be absolutely spot on, but he's got uninsured people on either side. They cause the loss somehow. The fire starts in there, or whatever. Alternatively, if there's an earthquake and let's say it's a block of 4 units is destroyed, well, he's got the money to replace his, but the others haven't. What do you do? Does he replace a single unit? So, you know, I mean, again, you've got all of these issues, whereas in strata title situations, you're valuing the whole complex. In the event of a loss, the whole complex is replaced, repaired, whatever. In a cross-lease situation, you've got these...
You've got no controls.
You've got no controls, and to me, again, you come back to these post-loss situations, you're going to have lawsuits going left, right and centre because the neighbour didn't do his bit and so on and so forth. Whereas if the cross-leases similarly had to insure as a single unit, you would overcome those problems.
Shared driveways. When I talk to many of my clients who are on these long driveways, and all the other next door neighbours either have their entry off this one particular driveway, that long driveway actually belongs to all of them. but sometimes there's no accountability for that long driveway in the equation for the total value of the home.
There's two different scenarios. One is where it's a jointly owned access driveway,
Yep.
where all of them have a 1/10 share for 10 of them, or 1/5
Yep.
share, or whatever. In which case it's a sort of like a separate title, and each of them
Yep.
has a 1/5 share. And the other one is where it's a right of way, where you might have 6 properties, all with a 1.5 metre wide, so that you've got a sort of a track. In terms of the ongoing maintenance obligations, the right of way does have easement documents,
Right.
and normally there is inherent responsibilities for all of those who have the rights of way, because it's a shared right of way, to share the costs of repairs and maintenance and things like that. That may be the legal position, but the practical position is that you have people who just don't want to know. They won't contribute, they won't do anything to improve it, and you typically get the 1 or 2 property owners who are the driving forces who finish up making the improvements because they particularly want them, and these other people benefit from it. So there's all sorts of iniquities with that. With the jointly owned access driveway, I think you're in exactly the same position.
Yeah.
So in terms of insuring, it's kind of a difficult one, because you only may have a 1/5 share in that jointly owned access driveway.
Yep.
But if it's destroyed in an earthquake, or it's probably the only way you could destroy it, you would hope, is all you've got, that the other 4 have got cover as well.
Yeah.
The only way to get around that is to include the full replacement of the driveway in your policy, but then you don't want to take the extra premium that goes with that. It's unfair, you shouldn't have to do that.
Do you think it's appropriate that in that situation where you've got a shared driveway, that all the other property units or properties that actually use that driveway should create sort of like the equivalent of a body corporate?
Yeah, I mean that obviously would be an ideal situation, but to try and motivate some people into doing it, or to agreeing to that, would be fraught with all sorts of dangers. I think the only practical thing you can do at the moment is to literally go to the other 4 owners and say, look, my insurance is up for renewal. I'm renewing 1/5 of the replacement of this driveway. I'm looking to you to do your 1/5, and so on. And if you're getting vertical nods from them all, with some degree of confidence, you can assume that if the driveway is destroyed, that there'll be 5 insurance policies contributing to the reconstruction.
Because we don't want horizontal nods.
No, if it starts going horizontal, you're in trouble. And unfortunately, there are always disputes in these jointly owned driveways and rights of way and things like that, because there are some people who, they just don't want to pay their share, they don't want to pay their contribution, regrettably that's always going to be a problem, unless, like with the cross-lease situation, unless maybe legislation was amended to make it an obligation that, in a common driveway situation, that property owners are responsible for 1/5 of all repairs and all replacement in the event of insurance losses. Something that has teeth, that the other owners can maybe, use to force recalcitrant sort of owners to participate and to pay their share and to do what they're supposed to be doing.
So when a valuer goes and does a valuation on an apartment body corporate, what's the normal process?
Well, typically you would have the construction plans I'm assuming we're talking a multi-storey type thing, and you would be working out your valuation on an elemental basis based on those construction drawings, the standards of finishing, the standards of structure, is it reinforced concrete, is it structural steel, is it precast concrete panel exterior, or is it some other Aluka bond, or whatever it is, you'd be working out your elemental cost, a breakdown of it. Now, and as I say, if an owner for some reason has changed structurally, I mean, the obvious ones would be penthouse apartments.
Yeah.
If they were to, I don't know, add on, change, whatever, the roof structure or whatever, that would be recorded in some sort of
Yeah.
consent or whatever, and then that information will be provided to the valuer when the next revaluation's done. He would adjust his
Yeah.
elemental figures accordingly.
Is it necessary for a valuer to actually go along and actually have a look at the apartments each and every time?
I think that sort of goes beyond a normal insurance valuation. You wouldn't be doing internals of individual apartments as part of a body corporate revaluation. As I say, I think the internal issues are more of a contents cover, and so every owner would be insuring his own apartment for his contents and his, and his fixtures and fittings and all those sorts of things. The body corporate would be valuing the structure,
Right.
and the services, the lifts and hydraulics and electrics and those sorts of things that run up the central cores, and then the individual owners would have those in their own apartments.
So which brings me on to the commercial side of things.
Mm-hmm.
So we insure commercial buildings for replacement value. Many of the buildings are insured under body corporates, but we still have those buildings that are standalone. And now we also have issues in regards to the buildings being earthquake proof up to a certain level.
Yep.
So what's the effect upon the change in regulations and making a building earthquake proof for those body corporates and also for those standalone buildings in regards to ongoing valuations?
Well, of course, full replacement assumes full replacement in terms of the current regulations. So whatever the current situation of the building, your replacement cost would assume 100% compliance with the new earthquake regulations and all the new building codes in terms of electrics and hydraulics and whatever. Okay? So that's on one side of it. In terms of your indemnity side of it, which takes more into account the physical depreciation and issues of obsolescence, and that would pick up your level of earthquake cover, and obviously that percentage of earthquake cover or compliance with the earthquake regulations is what the insurance company is going to look at very closely in terms of pitching its premium, isn't it? I mean, if it's 100% compliance with the earthquake regs, the insurance company is obviously a hell of a lot more relaxed about insuring that building than one that's maybe 65%. And the premiums would show that, all other things being equal. So in terms of the replacement side of it, I don't believe that is an issue, because you're valuing a replacement figure that assumes full compliance with the current regulations, and that's stated in the valuations, and that's certainly how you put together your elemental cost breakdown. More complex when you're looking at your indemnity covers.
Okay. So when we're talking about indemnity cover, to me and to many of my clients, we're actually saying in the event of a total loss, indemnity value is going to be the amount of money that is going to be negotiated with the insurance company for a financial cash payout.
Correct. That's it. That leaves him in the same financial position he was before the loss.
Okay. Yeah. But now we're getting into a situation where many of the buildings, say pre-1985, the indemnity values are now falling below a certain threshold placed by the insurance company of either 30% or 25%, and they're now saying, no, we don't want to have a bar of this.
So they'll insure for replacement only.
Yeah.
I mean, you can understand that. I mean, if you took a 50-year life on a building, you're in the mid-1950s now. and buildings built in the mid-1950s would not come anywhere near the current earthquake standards without significant strengthening. Now, it's like the argument that they're having in Wellington with historic buildings. The owners, that there is just no commercial reality to carrying out the requisite earthquake strengthening in terms of what sort of financial return you can get back from it. That then suddenly means, well, the only person that's going to carry out required earthquake strengthening on historic buildings is going to be either the government or a local authority under some sort of philanthropic sort of public good, and it becomes a public asset at the end of it. So the insurance company, you can understand their position, I suppose. I mean, their risk on insuring an old building that doesn't comply with the earthquake regs, particularly in Wellington, I suppose, and even in Auckland, is quite understandable. And at the end of the day, you probably, other than the value of the land, there's no value in that property at all, because the obligation to strengthen and upgrade the building would far outweigh the end value of the property, of the building.
In Auckland, we've got now a 12-year window to comply with the new regulations.
Right.
From feedback in your particular sector of the industry, are we progressing towards becoming compliant, or are people sort of burying their heads in the sand and saying, hopefully by the time the 15-year period comes up, I've gone?
Look, to be honest, I haven't had any feedback on that at all, really. Most of the stuff that I've been valuing for insurance purposes has not had an issue with earthquake compliance. I mean, a lot of the stuff, for instance, up around Albany here is all 15, 20 years old, and it's all pretty good. And the same with a lot of the sort of the fringe stuff around the CBD, the Graftons and the College Hills and that. I mean, a lot of that stuff was built, in the 1980s, 1990s, and it, with the 1970s, the first real upgrade in building codes to reflect earthquake issues came into force, and so most of the stuff built after the 1970s has actually got a pretty high level of compliance with the current regulations. So, and Auckland doesn't really have the level of sort of historic buildings, say, like the Wellington does it? I mean, most of it seem to have been knocked over and new buildings built. One
of the other things we've discussed in the past, Brian, is indemnity periods for loss of rents, but also for the rebuild of properties. And many business owners still have this viewpoint that it's only going to take 12 months for a building to be rebuilt. But due to earthquake down in Christchurch, we know that that's not correct, and we also know from the housing market that to get building consents, etc., it takes 8-9 months before any work starts to get the consent through. So, in your experience, what advice would you give to a building owner in regards to allowance of time to get a building reconstructed?
Yeah. Well, I mean, from the date of the loss, you've got site clearing, consents, and in some cases, you're building under existing use rights. So you've got very heavy restrictions on what you can rebuild. Whereas in case of a total loss, you can sometimes amend, what you've got, make adaptations and things. So there's all those manner of things, as you say, getting through council for consents. And when we do insurance reports, we're really working on the assumption that it's a one-off. That it's a one-off loss and that materials are available. In the normal course of event, it'll take you 9 months, 12 months, whatever, to rebuild. in the event of a catastrophic loss, an earthquake, you know, volcanoes, whatever, you know, all those bets are off, and who knows how long the reconstruction will take. I mean, it's a level of crystal ball gazing that we probably can't hope to. I mean, we could add value to the discussion, but quite honestly, you know, with Christchurch, was it going to be 2 years? Was it going to be 4 years? You know, I mean, and while you could say in an insurance valuation that, look, this is a one-off, in the event of a catastrophic loss, this indemnity period may be woefully inadequate. But I mean, how do you cover for that? You know, I mean, that's more of a question you have to ask than we do. But I don't think there is an answer to it, because you just don't know how catastrophic the loss will be, what sort of run on building materials. I mean, I imagine you know what the delays were in Christchurch. If there was a catastrophic loss in Auckland, you could multiply the Christchurch situation by, I don't know, 3 or 4, I suppose. I certainly think that company directors have to know about those sorts of things, because, you know, quite clearly now, in the event of losses, shareholders will be looking to directors. Well, directors obviously have an obligation now to protect the, you know, I mean, under OSH, to protect their staff and that, but they also have an obligation to shareholders to protect the assets of the company. And so all of those risks need to be put in front of them, and they need to make decisions on what level of cover or how they're going to deal with it. Now, they may well say, look, we believe that's an unreasonable level of insurance cover to put in place. We think if we insure for, you know, the indemnity period is 2.5 years, just based on, you know, demolition and new consents and construction and all the rest of it, and maybe add 6 months on as a risk premium. It would be very, very hard for shareholders then to sort of say, well, hang on, you've underinsured us and we've got this loss and that. I mean, you know, as a director, you're not supposed to be, you know, a mind reader or a reader of the future. But you've addressed the risk. You've put in place what you believe to be a reasonable level of redress to cover that. And I think as long as yourselves as the brokers and that just put those issues in front of the directors, and as long as they've got the information, you know, they can make intelligent, informed decisions on those risks. I mean, for instance, if you went to a board of a public company and said to them, well, look, these are the sums insured for all your buildings, these are your indemnity periods and so forth. Now, don't forget that in the event of a catastrophic loss, your indemnity periods may be woefully short. The first thing they'd say to you, well, John, what is the probability of a volcanic eruption in Auckland in the next 10 years? Well, you know, what are you going to say to them? Look, you got 1 chance in 1,000, 10 chances in 1,000, 100 chances in 1,000.
We're on the wrong side of the 1,500 years.
Whatever. So then they can, with that information, they can say, well, okay, the probability of a volcanic eruption in Auckland, which is going to be our major source of loss, potentially, you know, other than maybe fire or something like that, but and then they can make informed decisions based on those risk probabilities. You know, that is something quite different from, you know, the situation I remember with Toyota in Australia, where they worked out what the highest risk exposure they had in their car assembly plant, and they worked out it was going to be their computer facility. So they built a concrete bunker around their computer facility and thought, job done, you know, we've sorted that. And of course they had a fire and all the girders buckled and came down and crushed their computer centre. So it wasn't a fire loss, it wasn't a, you know, it was something totally unforeseen by them. But that's because they probably narrowed their view down, focused too much, you know, and limited what they thought their risks were. But I think if the company directors have a comprehensive risk report in front of them, they can make informed decisions, and I think at the end of the day, as long as they have considered it and made informed decisions, the shareholders can't really hold them to account if some unforeseen thing happens.
Family trusts owning buildings.
Mm-hmm.
The trustees have the same level
Absolutely.
of responsibilities as a director to shareholders.
Absolutely, and probably historically in law terms more so.
Yeah.
Yeah.
Yeah. So does that conversation come up between you and the clients who ask for the valuations, and you find out that it's a trust, and say the client is coming to you saying, actually, is there a way around not actually having to insure it for replacement value?
I think that conversation is more with you guys, the brokers, than it is with us, the valuers.
Yeah.
I mean, we're typically brought in after you've had that conversation, and they've been persuaded by you that it would be good practice for them to have a detailed valuation done or updated or whatever, and so that's when we come along. We wouldn't typically get into any sort of risk cover discussion with a client. I mean, if they started talking to us about insurance cover, we would just say, well, hang on, we're valuers, we're not your insurance brokers, go and talk to you guys. No, that's dangerous territory, sort of giving advice on cover and the do's and don'ts.
Yeah, which is the reason why we don't do valuations as well.
Touche.
Yeah. So, some years back, you also were getting very much involved with business continuity, and we've actually just touched on it now with dealing with shareholders and directors and replacement of buildings over an indemnity period. Do you think that it's now more than ever necessary to have those business continuity plans?
Absolutely. I mean, I believe that is part of this overall picture we were talking about. Say, if we take the company sort of situation again, the directors wanting to know, in the event of a loss, what the staff do, what the company does, to keep the company going. I mean, if the company's going along swimmingly, it has a loss, be it a fire, whatever, and the business fails, the shareholders are going to be real grumpy with the directors if they say, well, hang on, how did you not foresee that you needed, to have your computers backed up off site so that we could carry on, that staff were all going to meet in a certain area, that somebody was going to go and hire alternative premises, and we were going to go and set up, and I mean, all of that needs to be set out, and it can be as detailed or as brief as required, depending on the size of the company, the complexity of the company. But a good example was probably in Auckland in 1998 when the power was cut to the CBD.
Yeah.
You had some tenants who just simply closed up shop until the owners put generators on or whatever. You had others who the next day were in a motel out in Green Lane, and the business was carrying on. They were
Sorted.
They were sorted. They had a plan. The staff knew exactly where they were going. They had their computers and backup systems and everything in place. Hired the whole motel for a couple of months. Set everybody up, and away they went. They may have lost 2 or 3 days of business. Other ones, who knows, they weren't fast enough to get a motel, or didn't think about it quickly enough, or the landlord didn't get a generator on, or whatever. There were some disaster stories there.
Yeah, because I often talk about business continuity plans to a lot of my clients, and that's even the SMEs as well. And they have a real issue in grasping the concept of it, because they see that insurance is going to be the sole answer to all of their problems. When you went into the business continuity side with your previous business, what was the major trigger that actually started you on that road, and why did you do
Well, obviously with Rushton's, there was an English connection with the, the mother firm in the UK. In the UK, I think, the whole business continuity planning and consulting side of things was probably much more advanced. I don't know whether it was because the companies were bigger or what the situation was, but maybe the insurance industry in England was just older and more mature, and people understood the reason for these things. I really don't know why it was, but we developed certain programs in Australia and in New Zealand. In Australia, they did a lot of business continuity planning with local authorities, where it was kind of essential to have continuity of services and things like that. I'm not sure what the situation was in Christchurch, whether they had any continuity planning in place there. I haven't sort of really looked into it. But again, it comes back to the directors of companies and their responsibilities to protect the shareholders' assets. And if a company goes broke after a loss because they didn't have a plan in place, the director's going to be found wanting. And it's all very well to sort of fall back on directors and officers' insurance to cover any claims and all the rest of it, but that's kind of sidestepping the issue. And because my real feeling was the reason that it hasn't taken on in New Zealand is purely cost. I really believe that is the situation. I think CEOs just don't want the extra cost of putting into place a continuity plan. The fact is, it's probably a one-off plan that needs to be picked up every 12 months, and somebody go through and just see if anything's changed, if any of the contact phone numbers are different, things like that. And if it's computerised, it can be updated by somebody on an ongoing basis. It's not a major cost. The first setup cost, yes, there will be costs, but to convince CEOs and company directors of the necessity of that expenditure, again, is one of is part of that whole risk discussion that you guys have with them. And if you keep asking them, what is your business continuity? What happens if, tomorrow your place is burnt to the ground? How are you going to carry your business on? And let them answer it.
Question is, how many brokers are there that actually ask that question?
Well, that's probably something for the Insurance Institute to, as part of the education process, I believe. The biggest problem we've got, of course, is complacency. If there's been no, Christchurch obviously scared the bejesus out of most people, and they all rushed around like, chooks without heads, putting in place all manner of cover and making sure, have we got this, have we got that. But then it all settles down, a bit like what we were saying before about the insurance companies now saying, we'll give you a total replacement cover, no need to go to the sums insured anymore. And we just get complacent. Then you have another big loss situation. And the thing with business continuity planning is, thankfully, there hasn't been a history of companies going belly up. And so CEOs look at it again and say, what's our risk exposure, Probability, low. Let's move on, yeah. So that's what you're fighting against. As I say, I believe from all the discussions I had that they couldn't convince me that it wasn't a good idea, but they just couldn't see the financial benefits in doing it. And I really do think that that's what it came down to.
And there's an awful lot of businesses out there that actually operate from home, home offices. And yet we're only insuring those dwellings on replacement value subject to evaluation. But if it's actually used for businesses, or for the purpose of business, in fact only one room or two rooms, and bringing back the issue of business continuity, it sort of places the business owner into a rather interesting position.
Yeah, there's two separate issues there. One is there's probably not a great deal of difference in your replacement value cover for the asset.
Yeah.
I mean, the house is a house, whether you're using a couple of rooms for offices or whatever, unless you've adapted it significantly
Yeah.
for offices, you may adjust your sums insured. And then, because the business continuity thing is a totally separate exercise,
Yeah.
as would be the contents of the offices would be
Yeah.
different from the house contents, you know. So,
But it's working out a plan though, isn't it, as to what you want to do and how you're going to maintain business and how soon are you going to be back in your property to enable you to carry on doing your business.
Yeah, the principles are exactly the same, and they're exactly the same whether you're an Air New Zealand or whether you're a guy working out of your office at home. I mean, but as I was saying to you earlier, it depends. That simply dictates the level of detail you'd need in a business continuity plan. You know, with an outfit like Air New Zealand, the business continuity plan would be reasonably complex, but the beauty with an organisation like that, where they've got multiple buildings and things around, is in the event of a loss in one, they can move their staff into another one temporarily until they sort that out. So not that difficult to put in place. And with a guy operating out of his bedroom at home, same thing. Not that difficult to work out a business continuity plan, and can be achieved with a hell of a lot less detail than, say, in Air New Zealand.
Cool.
Yeah.
Well, Brian, thank you very much for your time, and I'm sure that the information that you've got will be greatly appreciated by all the people that will listen and watch.
Okay, thank you.
And it's been a real pleasure. Thank you very much.
All right.
Thank you.
Cheers.
All right. Cheers.